Hi everyone, welcome to this second half Outlook call 2025. And I actually did the last quarter call, but because of all the stuff that happened with Trump and the markets just fell so much, it didn't feel relevant to publish it. So I didn't, and I left that update video up instead. But this time around, I think it's a little bit more relevant. And we are expecting a little bit more fireworks, but we didn't. So it's good for us, and we can do the update. As you can see, this is a new setup that we have. I'm trying things out. This is one of the things I'm trying. And if you like it, let me know. If you don't, just give me the same feedback. It's just fine as well. Okay. So yeah, I just want to go over again the investment objectives of what we're trying to do, the investment process, who I am, just briefly. Recap of 2025, the first half, and the outlook of the second half of 2025. So investment objective, as you all know, I was very close to my family, and the reason why I started trading on eToro is because I found that for regular investors, you can see it right here, the game's not fair. Like, if you have high net worth individuals who have access to a lot of money, they have a lot more tools and therefore are able to, manage their money in a more sophisticated way, which I think retail investors doesn't have. So myself, when I came into eToro, I wanted to bring those like more sophisticated methods and try and express it simply. And the objective of that is really to reduce drawdowns or losses as much as possible in bad times. And in good times, just really capture as much upside as possible. Um, yeah, a lot of problems with the industry happens to be fees. If you are a regular investor, if you go to a bank or insurance companies or whatever have you, they tend to sell you very expensive products, and that's because they just want fees. On eToro, we've managed to find a way to become so efficient that we're able to charge very, very low fees. And on the third point, we also are completely unable to lie. So if I tell you I have a certain performance, you can see it on my eToro profile. I can't lie about it because it's all truth. And you may not know this, but for all popular investors, we're only allowed to have one account. You can't open multiple accounts, try different strategies, and only sell the best one. We don't allow that. You only have one account. And I find that to be absolutely one of the best things ever because a lot of people just try a lot of different things and just try and sell the best product that they have, but it's all just random and they don't show you the worst performing ones. So yeah. So again, the objective is to create such a fair environment and allow people to like invest in a very interesting way. Yeah, so like I said, the first point, access to very sophisticated methods, own capital. So we have to put in our own capital, our own skin in the game. So if I lose money, you lose money, or you lose money, I lose money, I feel it as well. And completely truthful, we covered that. And eToro is just such a good solution to it. And I really, really so passionate about it. And I've been on the platform 9 years, gonna be 10 next April. But yeah, I think it's really such a good solution to the financial chaos that's going on. Yeah, and I also wanted to cover this as well. Like I saw this on Cointelegraph. I thought, it's interesting. A lot of traders, Twitters and YouTube, whatever, they tend to create accounts. They tend to become very hyped. But what happens when they kind of blow up? They just disappear. You can see they just deactivate their accounts and just disappear. Very common in the financial world, and especially for retail, it's just so common. And yeah, I don't think that's the right way to go. I don't think it's the right way for you to manage your money because the amount of stress that is behind it. And so eToro is such a good solution just to fix all this. I guess fix in that sense. It's just a better solution. Okay, so this is our investment process. What we really try and do is we try and find a lot of interesting ideas. Since idea generation, we have screeners and some tools that we use here and there. We have some AI as well, but I use the term a bit more loosely. It's in terms of the idea generation, but we do use a lot of AI. Idea framework is trying to figure out how we can find asymmetric risk, so reducing downside as much as possible with as much upside. And then after that, we go into the research of thesis validation. So we try and find articles or reasons why we may be wrong and reasons why we may be right and trying to validate those. So then we pick out the best ones and then we risk manage accordingly. Of course, I always cover this. I always hold a lot of cash and I have a lot of different bets. I think you see some popular investors with very few bets and they've done very well, don't get me wrong. But for me, when I study the financial markets, I tend to like this Ray Dalio's holy grail, as he calls it. And this is really the number of assets you have in your portfolio and how do you diversify across so that you maximize your return and minimize the downside risk. Having like six concentrated bets or one stock 25% of your portfolio doesn't really make sense to me because you may be wrong and it may not be your fault. And I've just seen so many different events that have happened, like great companies going bankrupt, overvaluations, scams and things like that. It's put a lot of fear, I guess, into me, but not really fear. It's just being smart about it because there's so many unknown unknowns in the financial world that you can't control for. So for you to say I'm gonna make eight bets and every year and these eight bets I was gonna pay off or have one stock that's 25% of your portfolio and that one is wrong, it's just too much of a risk. So it doesn't really make sense to me. So I tend to follow this holy grail of Ray Dalio, and that's why I have so many bets in different sectors in different countries. And hopefully they're just less correlated and therefore, provides us better return. Okay, so who am I briefly? Um, I'm sure most of you know this if you're watching this video. I'm the number one most copied in Asia and Australia. Sixth most copied globally. Uh, my professional experience, I've worked in the asset manager. I have investment banking. I've worked in crypto sell side, so it's like exchange, investment, business development, things like that. I've been trading since I was in uni, so actually before uni in army as well. So I've been trading for quite a while. I have a master's degree in finance, bachelor's in accounting, CISI, and all that. But I always say none of this matters. Like none of it matters because you have to be able to synthesize all the information, actually to follow a lot of discipline. So not everyone with a master's degree knows how to manage money. That's just a fact. Some people are just academics and that's the path that they choose. Some people are better at ops and that's the path that they choose, but not everyone is built or is able to do investment management. And I think all these credentials don't mean you can manage money. So I try to be as clear as possible about the way to invest and let people judge for themselves whether they like that approach. Okay, so performance review, stuff that everyone's been waiting for. Honestly, it does not get better than this. Like, we have done pretty damn well. If you all recall, last year I was a little bit disappointed at the end of the year because we were underperforming the S&P 500. But at the same time, I don't believe in benchmarks. It's just we underperform slightly. This year we're outperforming like 15.8 versus 6.6. This is like more than double of the S&P 500. Um, which is good, I can't complain. I think we did really, really well in this environment. So yeah, let's just recap some of the things that happened. So not this. So we closed Paramount Group. We had this. No, we didn't close it, but this was just good. And still ongoing. So what happened is that Paramount Group was trading at a very cheap valuation or price to book ratio. And we thought this because we looked at the assets in their portfolio and we said, okay, what happens if we take a haircut of these portfolios? And we realized that, hey, look, this is actually trading quite cheap compared to how much the assets are worth. So because of that, and because we saw the comparable REITs that are trading, they're all trading higher from price to book ratio. So we decided to go into Paramount Group and they announced like this strategic alternatives, which generally means they are looking to make a sale. And this happened May 19th. And as a result, in our portfolio, I think it's up like something like around 20-30%. So this was just great. And it's still open, but it's really good. I think it was a really good investment for us. Good and close. This one was a absolute no-brainer for us. We made 30 odd percent on this position. And it was a very large position. I think 10% of our portfolio at one point of time was in this one stock and it made 30%, so that's like plus 3%. So when we went into it, it's because we noticed that last year, especially, Europe was very unloved. Oil and gas, everyone hates, and they had a very large cash balance. So I actually made a presentation on this stock at the Value Investors Conference, or that I went for, and this was with all the professional fund managers and stuff that eToro was very gracious to send me. And I presented this as a thesis. So I love that trade so much because rough numbers, it was like worth 1.1 billion if you were to buy all the shares. And they had so much cash that the remaining value of the shares, you're just valuing it at a price earnings ratio of like 1 to 2, or maybe 2 to 3. So very, very low. It didn't make sense to me because I thought it was a pretty stable business. Like it wouldn't go up and down like huge amounts unless there are like strikes and stuff like that, which happened. So that's also why the market discounted it. But I thought like going forward is going to be a really good asset to hold. And we took that view, and obviously private equity saw the same opportunities we did. And so they decided to go in and make an offer, or ESSO decided to sell it because it just wasn't worth, ExxonMobil just decided it wasn't worth having on the balance sheet. And they sold 100% of their stake, which is a very significant stake. So the stock kind of just took off from there, and we were in it, of course, our largest position. I still think it's too cheap. I still think they should have sold at a higher price. But um, like I said, in the beginning, there's so many uncontrollable things in the market that sometimes we just have to accept that this is how it is, and therefore, we just sold. We made a profit and made what we could, and we just got out. So yeah, this was great. This was less than a year. Trade is less than a year old, and somehow, we made 30%. I think it's great. Absolutely fantastic. Um, so this is good, but really strange. So Valaris is a offshore, what do you call, oil and gas. I'll just summarize it like that. And it's been so super volatile. Like if you look at the time of when we even went in, this says minus 65%. So top to bottom, 65%. There were some of our positions, they were like minus 50%, negative this, negative that. And it's just very, very volatile. And there are a couple of reasons why it's so volatile. There's short sellers, there's things that we can get into. But the point is, we know that if the market wants to buy OSVs or make OSVs or make the assets again and buy it from the market or whatever, it's going to cost X amount of dollars. And the truth is, the market's valuing these assets much, much less. So a lot like Paramount Group, they're just valuing the assets a lot less than what we think they're worth. So, and that gives us the confidence to go in and buy, especially as low. So when you see these positions here, we opened this during the tariff tantrums. We were like, okay, the market is like discounted so much that it really doesn't make sense. So we started buying, buying, buying. In fact, if you look at the position now in our portfolio, it's still a loss. So it's still a loss. But because we had so much confidence as the market was coming down, we bought more. And as it recovered, we just trimmed back to positions, and we just made some profits here and there. So you can see here we've actually made almost 50% on some of these trades. Not really trades, but portfolio management, you know, that kind of thing. You can see it's only been like 2 months and we already made that kind of return. So these opportunities are really interesting, but you have to be quite active in monitoring all the time. So yeah, I love these trades. Okay, again, bad but good. So this has been super like annoying because we've been holding it for such a long time. I think it's been like 2 years and we're still holding on to it. So this is one of our largest positions, which is 33223, which is China Construction. Um, and what happened was it increased by 30% and then dropped all the way back from, you can see here, this is the start of the year, it increased 30% and just dropped all the way back down during the Trump issues, right? And then recovered straight back up. So, like Alibaba, like it's gone up, it's given back a little bit, but it's generally up. 323 at one point just gave back all of his gains, which was like super depressing at some point during that. But it's one of those things you can't control, but you know that the fundamentals are good, so we continue to hold it. Even if you look at China Railway, you can see here this is the start of the year, and there was this like it just dropped, and it eventually recovered, and we started buying more and stuff like that. But the general thesis is still holds true and still holds the same. Chinese red chip stocks, which is owned by the government, is unlikely to fail. So downside risk is limited because unlikely to fail. Pays really good dividends. You can see here China Railway pays 5.11% of the dividends, and uh, China Construction pays 3.87, so really good dividends, but also cheap valuation. So these 3.27 PE ratio and 14.55 is on the high side, but that you can talk about construction industry in China. This is considered a very suppressed value. So, I would consider very suppressed value and should, return to long-term averages soon, and that would be positive. But yeah, so it's good. Like it recovered, and we made a little bit of money from the beginning of the year, but it's been tough to hold on to. It's been this tricky thing. Yeah, look at China Railway. It's like a railway company. There's nothing interesting or scary about it, but 5.11% dividend, we can't complain. And even if it drops so much, it just recovers back. It's not up by a lot this year actually, but it's still good. It's still recovered. We didn't lose any money. We got some dividends out of it, so it's good. I wish this could be better. This is by far our largest position in the portfolio. This is Danios. Um, Again, we're looking at asset values. So ships, how much are they worth? So we know that from various research reports, how much a ship is worth. We know that Daniels has a lease on like the average lease. So they lease out container ships, right? And we know based on their annual report, it's like 3.9 years. And it's trading at P/E ratio of 3.63. That means your forecast for the next 3.9 years is pretty much set. You know how much you're going to get from these leasing activities. Oh, sorry, you know that these ships are leased out for 3.9 years, and if they keep current ship rates, you are going to get a pretty steady income. But at the same time, you know that at the end of 3.9 years, you still have that ship. It's still an asset. The ships don't disappear after 3.9 years. You still have them, right? So there's an asset value there, and it's still trading at 3.6 P/E ratio. So it's very, very cheap. Most of the stocks, I'll show this a little bit, but most of the stocks that we buy tend to be on the cheaper end. And again, this is because we're looking for asymmetric risk, so as little downside as possible, as much upside. And also, given valuations, we are confident that if the market drops, we can go in and get some more. And that's kind of where we want to be. Okay, so this is to me good, but hasn't kind of gone into profit yet. So I've covered this many, many times in quite a few calls, and we've held on to this, we've traded in and out, but the thesis still holds true. This is called a carry trade. If you go into your eToro platform, and you try and open a trade, and this is like $1,000 with 10x leverage. You can see here there's something called overnight refund, which means that if you hold on to this position and do nothing, eToro will pay you. And the reason for that is because of the difference in interest rates between the Swiss franc and the US dollar. So if you just take these numbers, 86 cents off $1,000, you leverage about 10 times, and 259. And what you do is you kind of just add these numbers up, you get about 29%. So yeah, it's just a really interesting position. I don't know why these numbers are off. I gotta check that. But um, yeah, it's just a really interesting like, and this is a lower number than this, by the way. So if you think about it, this should be higher. But yeah, it's just very interesting that these trades exist. Of course, if you just buy and hold US dollar Swiss franc, it's not going to do well because the currency has just been going one way down. Um, but we are on the long side, so we're hoping for rebounds, right? And we've traded in and out of this position, have gotten a little bit of money here and there. This continues to just be uncorrelated to the rest of our portfolio, just a very interesting return profile. And it's just, if the stock market goes down, does this necessarily go down? The answer is no, because, if there is flight to safety, means the market's scared, US dollar tends to go up. But over the long term, everyone is like, US is printing money and all this is going to zero. While I agree with you 100%, I don't think it's going to zero tomorrow. It's going to take some time. And, you have to find an alternative. And Bitcoin is not quite there yet. I don't think gold is there yet. Um, I don't think euro is there. I don't think the Chinese yuan is there. BRICS countries, we can talk about all that. But the truth is, all these are just theories and they take time and they take infrastructure, especially. So US dollar is not zero tomorrow. And in between, we can play these kind of in and out, and I guess, and making a little bit of money here and there, and uncorrelated the rest of the portfolio. So yeah, I really like these trades. So yeah, I can't complain. It's just been so good. Like if you think about like how much we got based on benchmarks again, like S&P, we've done more than double the S&P 500. So it's been great. Um, so yeah, just a quick outlook on how I see the rest of 2025. Uh, so I covered this last week on my eToro wall that I really like David Wu on Bound. Like I think one of the best analysts on YouTube by far. And he's negative. Like he is very negative on the US on the stock market basically. He's saying valuations are high. And I agree with him. And he says that, stock markets should come down at some point. Maybe. And on the other side, this another podcast I watch all the time, or this is Macro Mondays by Andreas Steno and Mikhail Rosford. So this is Macro Mondays on Real Vision. Such a good podcast. Every Monday, their coverage is just absolutely spot on. I love it. I love both of these sets of information. They are bullish on the economy. So David Wu is bearish. Macro Monday is negative. So, sorry, positive. So one bull, one bear. Um, so the answer to that is I don't know. Like in the short term, it's going to be very tricky to tell because valuations in general go up, especially in the US. And because it's gotten so much attention because of Mag 7, because of AI, there are a bunch of things we can get into. But the point is valuations are high and negative news causes it to come down. Positive news, it's going to go up. I don't know. What I do know is this, I am a little bit more cautious now than I was at the last update. So in first Q 2025, I was a little bit more bullish. I had a little bit more optimism because we've already fallen so much. So we could add into our positions. But right now, I think I am a bit more cautious and we're standing pat. I don't want to add too much more risk to our portfolio right now. So the way we're managing this is we're holding a lot of cash. If you go to our portfolio now, I think it's about um, maybe 30, I think I have the number somewhere. Yeah, there we go. So we've got about 18% cash now. So when I said like the last quarter I was more bullish, it's because we only had 4% cash and everything else is just deployed because risk. We just felt that we could take more risk, but now we scaled back and we have a lot more cash. So yeah, cash is something we're gonna hold on to because I just don't know. This market is just so tricky right now, so I just don't know. I also have some hedges on, so we do have the dollar CHF, which we talked about. You can see here we're losing some money here, but again, we are really interested in these interest rate refunds that we get. So you got to factor both of these in. So I see this as a hedge because should the stock market come down, should everyone fly back into US treasuries or whatever have you, then this would go up. So I see that as a possibility, especially in this trade war. The other is the VXX. So this is a volatility thing. As you can see here, it's very asymmetric. Like if it drops, we lose like $300-400 on this position. But if it goes up as much as how it did in the first half of this year, we make 1,000 too. So very asymmetric, but very low probability. So if you look at the VXX, it's only headed one way. It's only gone down. Here you're going long, so you're looking for a spike up. And spike ups only happen when there's like this tariff issues or some kind of war or whatever have you. Then this will come up. and we will make money from these. But right now, I'm just using it to play it safe. Okay, the other thing we're doing is we are always, and we talked about this in the first part, like trying to get as much asymmetric return as possible. So we have very low P ratios and price to book ratios compared to other investors. And this is not to say we don't invest in growth stocks. You can see here that I do invest in growth stocks. Like CCOI, I think is a great, interesting growth stock that I really like, infra play, internet related and AI related. I really like it. And you can see here, even for P ratios, we do have like Jackson, which I think is a great insurance company, and KROS, which is a pharmaceutical company. And you can see here is like super negative PE. So it's not to say we don't invest in different types of not just value assets. We do growth as well. But what I'm saying here is right now I want to focus more on value assets because the risk, upside risk versus downside risk right now is so asymmetric. I think if it goes down, it could go down really quickly. And if it goes up, I don't think it goes up by that much. So at these points, I'd rather have value more than growth stocks. So yeah, that's kind of it. You can see here, Danaos, our P ratio is only 3.63. Just to compare it, like Nvidia, which is the number one most traded stock right now, eToro is 55.2. So on these valuation basis, what we're expecting for Daniels is a 27% return every year. And for Nvidia, we're expecting 1.82. So I'll let this sink in for a bit. So why is there such a big difference? Generally, growth stocks have higher PE ratios because you're expecting this to grow by a lot. So expecting Nvidia to grow maybe 10%. So therefore your total return is 11.81%, something like that. And that's why the PE ratios are so high. But for Daniels, you're not expecting this to change much or even come down. So 27.55, you expect it to come down to maybe, I don't know, 20-ish%, which is still great. I mean, to me, 20% a year is still a great return. But whether Nvidia is going to keep going up by 10% every year, I don't know. AI is great. I use it all the time. But has spending kind of tapered off? I don't know. And one interesting study is that CapEx cycles, which is capital expenditure cycles, they tend to go for 6 to 8 quarters. And we've actually passed that. Nvidia is still like growing revenue. So I don't know. It's too hard for me because I think if it goes up, it goes up a little bit. If it comes down, it comes down a lot. As you can see what happened like in the first half of this year, right? It just came down like so much. But yeah, crypto, we gotta talk about crypto because I love crypto. I love coding in crypto, but it's no longer the asset I fell in love with, to be honest. I still believe in it. I still have hope for it, but it's no longer the asset I fell in love with. I love Ethereum, for the plain reason of I think, Bitcoin is great as a store of value, but doesn't do anything else other than that. Ethereum does a lot more, so I like Ethereum because of that. And it's just dropped a lot against Bitcoin. So Bitcoin has gone up because of the ETFs and positioning and hype and everything like that. Ethereum has really not caught up except this week. Like this week, Ethereum has gone back to 3006. So it's finally rallying. It's not even close to all-time highs of 4,000 plus, but it's finally rallying. So we'll see how long this goes for. And given the risk at the current market, I'd rather hold Ethereum than Bitcoin, just because I think it's just a more interesting bet. But again, crypto, I'm not sure. I'm really not sure. Yeah, that's it. Hopefully I didn't take too long for this update call. And yeah, have any questions, always just ask me in the comments and I'll get back to you as soon as possible. Yeah, thanks for listening.